Hello, Internet friend. Today on Value Side, this week's economy, Donald Trump and the campaign for lower interest rates. I'm David Ravel. Well, President Trump's relentless campaign for lower interest rates began shortly after he took office for the first time back in 2017. After his second election in 2025, Trump then told the World Economic Forum that when he's inaugurated, quote, "I'll demand that interest rates drop immediately." Undoubtedly, Jerome Powell's refusal to accede to Trump's demand for lower rate caused the friction between the two. Trump railed against Powell repeatedly, calling him a moron, and even threatening legal action against Powell for the cost override in rehabbing the Federal Reserve's headquarters building. Although this later action had no relationship to interest rate policy, most seasoned observers saw it as Trump's way to lash out at Powell for failing to follow the president's wishes. Now, last Sunday, May 31st, Powell received the John F. Kennedy Profile and Courage Award specifically for his protection of the Federal Reserve's independence. In announcing the award, the JFK Center noted that Powell had withstood, quote, years of personal attacks and threats from the highest levels of government, a thinly veiled reference to the president. By now you may be asking, why all this hoopla over interest rates? Yes, it would be nice if they were lower. My bank might reduce my credit card bill or monthly mortgage payment. But does it really matter if my monthly credit payments decline? And the answer is a resounding yes. It really is critically important, especially to a select part of our economy, a part that increasingly feels that it's the center of America's economic and financial universe. It just so happens to be the same part of the economy that Donald J. Trump grew up in and flourished back in the day. Most Americans see Trump as a businessman, and by and large, that's how he campaigned for president. A successful businessman who would run the country just like he ran his successful properties. A claim, incidentally, that's come under some criticism. But Trump is certainly not a traditional businessman. His companies don't manufacture products, they don't provide a service in the traditional sense, and they aren't a mine or a farm. Instead, most of Trump's wealth comes from the purchase and development of properties and their subsequent appreciation in price. Think of Trump Tower, or Trump's first major development, the New York Grand Hyatt. In both cases, Trump took an existing property, the Bonwit Teller department store on Fifth Avenue for Trump Tower, and the old Commodore Hotel on 42nd Street for the Hyatt, arranged for financing, and then built the new landmark edifices. Of course, a million steps had to be undertaken, architect plans approved, zoning laws met, various trade union agreements, and the list goes on, all of which represents a major accomplishment for Trump and his organization. But the one irreplaceable step was the financing. Without the money, nothing would be built. So where did the money come from? Well, the answer is the lenders lent it. And that's all you need to know to understand Donald Trump's fixation on interest rates, the principal expense for all loans. As a side note, it was Fred Trump, Donald's father, who was the principal financial source for both the Grand Hyatt and the Trump Tower, along with the Equitable Life Assurance Company. Fred Trump provided the indispensable financing for both projects. So just what kind of business was Donald Trump operating in? The answer entirely depends on when in history you ask it. Trump's principal business lies somewhere between investing and speculating, but exactly what distinguishes those two has changed over time. There are two major ways that regulators and banks can control speculation: through interest rates or through loan levels. Higher interest rates or lower loan levels reduce speculation, but in contrast, lower interest rates and higher loan levels, and that's Trump's desired position, increase speculation. Let's take a look at loan levels. Over the past 50 years, we've seen the lending level for stock investments rise from 35 to 50%. Broker loan rates are set by Regulation U. However, it is possible to obtain a securities-backed line of credit from your bank, and there you can get a loan of 95% of the value of the stock. It's consistent with an overall trend towards greater and greater financial leverage, and hence more and more speculation. Now, at one time, home mortgages required a 20% down payment, but today the FHA requires only 3.5% down payment, while both the VA and USDA require no down payment at all. Hence, more speculation. Let's look at interest rates. Well, the historic trend has been to provide greater and greater loan levels. The most recent Fed interest rate policy, the one Trump rails against, has been to raise interest rates. When Trump left the presidency, the Fed funds rate stood at less than 1%. When he returned to the presidency, the Fed funds rate had risen to 4.3%. A dramatic rise, to say the least. And from Trump's perspective, it was a simple disaster. But from the Fed's perspective, tighter interest rate policy was working in reducing speculation. Inflation, which peaked in the second quarter of 2022 at 2.4% for the quarter, had declined by 2/3. What's more, the country's financial behavior was beginning to change. The push to borrow was declining. Across the board, the nation was slowing down on its borrowing binge. From the federal government to corporations to households, the rate at which we were going to the bank was finally declining slightly. It began to look like Trump's long campaign for lower interest rates now might work. Lower inflation and a reduced appetite for speculation. In other words, a lower demand for borrowing, and the Fed was free to accede to lower interest rates. And that's just what happened in 2025. The Fed went on a steady diet of reducing interest rates. But just when we thought we were out of the financial woods, two things happened that increased the cost of living, or in other words, inflation raised its very ugly head. The first was a jump in import costs at the beginning of Q2 2025. The president called it the most beautiful word in the dictionary, tariffs. However, no matter how attractive, the advent of tariffs broke the declining trend in inflation. As economists were quick to point out, almost all the tariff cost was borne by the consumer, increasing their cost of living and increasing inflation. And the second major inflationary boost came with the conflict in Iran. When Iran blocked the Strait of Hormuz, oil prices spiked, and gasoline rose to just under $4.50 a gallon. For the Federal Reserve, this latest round of inflation would put to rest any effort to lower interest rates. After all, the Fed's most effective tool in fighting inflation is to tighten or raise interest rates. So ended Trump's effort to lower interest rates. Now, on Friday, we saw a very interesting thing in the Dow Jones Industrial Average. It fell by over 800 points, an especially stunning number given the news that ignited this decline was very positive. It was an increase in the nation's payrolls, the number of people working. The Bureau of Labor Statistics reported that 172,000 people found a new job in May. And what's more, it turned out that the BLS undercounted March and April's numbers. The economy added a total of 64,000 new workers in those 2 months combined. Altogether, these are spectacular results and indicate that the labor markets are humming along nicely, thank you. Now, before stifling a yawn, you'll want to know that some of the wealthiest managers on Wall Street saw this news and promptly lined up at their favorite watering hole, Harry's, for a second double martini. All these new jobs represented the worst possible news for them. You see, just like the president, these are part of that vast network of financial speculators, property developers, venture capitalists, and other financiers to whom capital, or more precisely borrowed capital, is their chief source of wealth. And the explanation is somewhat complicated, but here's a brief version. The Federal Reserve Board, which sets short-term interest rates, is governed by two mandates. The Fed must seek to achieve an economy with full employment and stable prices. Now, as noted above, inflation is currently a problem. The Consumer Price Index is running at 3.78%, almost double the target. It would call for the Fed to raise, not lower interest rates to cool this type of inflation. So that left just one data point that could be used to justify a rate cut: full employment. If the economy were not creating enough jobs, then the Fed might still lower rates to help create new jobs. But Friday blew that thinking right out of the water. It's hard to imagine a worse payroll report for those who want lower rates. Not only was the May report with a gain of 172,000 new jobs indicating that jobs are coming along fine without any help from the Fed, but both March and April were better than those initial reports. In other words, the economy is creating new jobs just like it should, with no help from the Fed needed, and especially no need to lower interest rates. Instantly, any hope that Wall Street or the president might have had of lower rates just evaporated. It's more likely that the Fed will need to raise rates, not lower them. And that means that the principal expense for those who use financial leverage, namely interest, is likely to increase. Even a dovish new Fed chairman like Kevin Wash will likely see higher rates in the future, not lower. And that's today's Value Side. For all of our articles and podcasts, visit valueside.com. I'm David Ravel. Value Side is independently written and researched. The views expressed are strictly my own.